DocuSign. I mean, like, just saying the name, it almost makes you feel a little guilty about not using the printer anymore.
Right.
For years, that company was synonymous with just one thing.
Yeah.
That digital dotted line, that e-signature.
The hypergrowth phase.
Exactly. That was the adolescence. But today, this software icon is, well, it's deep into a complex, maybe even painful second act. It's trying to navigate these really choppy waters between being a simple utility and becoming a mature, profitable cash engine.
It's the classic innovator's dilemma, and we're seeing it play out in real time. DocuSign has the brand, everyone knows the name, but the market is asking, okay, what comes after the signature? Can they really transition their entire unit of value?
And that is exactly our mission for this deep dive. We're going to unpack the sources, dive into their recent Q3 financial results, which are fascinating, by the way.
They really are.
And then we'll apply a rigorous deep value checklist. You know, the kind of analysis that focuses on cash flow, on economic moats. We need to figure out if DocuSign is priced for failure or if it's actually primed for some major future success.
We're basically looking for the hidden value that the market might be overlooking right now.
Okay, let's get into this maturation story, starting with the numbers. Q3 fiscal year 2026. The headline is $818.4 million in total revenue. That's an 8% increase year over year. Now, 8% is solid, it's durable, but it is a massive deceleration from those crazy pandemic peaks when everyone was buying software. What does that kind of slowdown tell you?
It signals durability, for sure, but I think more profoundly, it signals maturity. When that hypergrowth inevitably slows, the market just shifts its demands. Investors stop caring so much about sheer user growth and they start demanding profitability.
And efficiency.
And you can see that strategic shift right in the revenue composition, which is critical here. Subscription revenue grew 9% to $801 million. It's making up a commanding, 97.9% of their top line.
So they're almost a pure play recurring revenue machine at this point.
Absolutely. And you see the strategy in what contracted, the low-margin professional services revenue. That shrank by 14%.
That's the part that costs time and people.
Right. It's exactly. Time, bodies, constant implementation support. Seeing that shrink suggests the product is mature enough to run itself. They're becoming a pure product-led growth, a PLG engine, not a service-heavy shop. It's a painful change, but it's very disciplined.
And here's where that discipline really turns into raw power, because despite that single-digit revenue growth, the cash generation is just phenomenal.
Incredible.
DocuSign generated $262.9 million in free cash flow, FCF, in that quarter alone. That's a robust 32% FCF margin.
That 32% margin is elite. I mean, it puts them in the absolute top tier of enterprise software companies. It's what transforms a former growth darling into a cash cow.
Right.
And that kind of efficiency means they can fund their next big strategic pivot without having to go raise debt or tap the markets.
And management is using that cash to send a message to the market, aren't they?
They're acting exactly like they believe the stock is undervalued.
Yeah.
They executed the largest quarterly buyback in the company's history. They repurchased $215.1 million of stock.
So they're shrinking the share count.
Aggressively. They're telling every remaining shareholder that they view this depressed share price as a huge opportunity.
Okay, so if we're trying to look forward, what does the underlying demand look like?
For that, we look at billings. It's the best forward-looking indicator for future revenue. Billings grew 10% year over year to about $829.5 million.
So 10% billings growth, 8% revenue growth.
And that's the key detail. The fact that it outpaced revenue growth suggests that the really painful period of customer optimization, where clients were cutting back on unused licenses during the slowdown, that might finally be ending. Demand seems to be stabilizing, maybe even accelerating again.
So the numbers paint this picture of stability, of efficiency, but we know the stock isn't priced like a safe, boring bond.
Not at all.
Which suggests the market is worried about something structural. Before we get to the risks, let's look at the engine, the core product. For a big enterprise customer, how does DocuSign actually make money today? It's not just a subscription fee, is it?
No. The basic subscription gets you in the door. But for those huge multi-year enterprise contracts, their revenue is metered by the envelope.
The envelope.
An envelope is just the container for the document being processed. It's a clever model because it links their pricing directly to how much the customer is actually using the service.
Can you give us a concrete example of that for the listener?
Sure. Imagine a massive bank. If that bank processes, say, 10,000 mortgage applications in a month, they pay DocuSign for 10,000 envelopes. It ensures DocuSign's revenue scales perfectly with the client's business volume.
So the platform gets stickier.
Very sticky. And the revenue is transparently linked to measurable value.
And the scale is just massive, nearly 1.8 million customers globally. But you always say the real stability is in that high-value segment.
That cohort is the key to everything. profitability, and predictability. We're tracking 11,165 customers with an annualized contract value, an ACV, of over $300,000. That high-end group grew 8% year over year.
And those are the clients they're targeting with this big strategic pivot, right? The intelligent agreement management.
Exactly. IAM. This is the move beyond the dotted line.
So for someone who only knows DocuSign as that little signature box, how different is this IAM product? Is this just marketing fluff?
No, it's a foundational shift. It's the entire contract lifecycle management system. It moves them from being a simple transaction utility to an intelligence repository.
So it's not just about signing the PDF.
Not at all. Instead of just signing a static PDF and archiving it, IAM uses AI to manage the data within that contract for its whole lifespan. It turns that static document into a searchable, actionable asset. The goal is to unlock all the data trapped in those agreements.
Things like payment terms, risk clauses.
Compliance deadlines, all of it.
That sounds like a big change. Are enterprises actually buying into it?
The traction metrics are surprisingly strong. IAM has already passed 25,000 customers, and they've ingested over 150 million agreements into their Navigator repository.
So that validates the thesis.
It does. It shows that enterprises desperately need to unlock and manage the legal data that's just sitting dormant in PDFs. The value is shifting from the commoditized signature to the high-value agreement record.
Okay, let's make that value shift real. Give me an example.
Imagine you're a compliance officer at a huge multinational. The EU suddenly passes a new labor law. You now have to instantly audit 5,000 vendor contracts across 30 countries for one specific clause.
Manually, that's weeks of work, millions in legal fees.
Exactly. With IAM, that audit happens instantly. It identifies the risk, allows for immediate action. That speed and risk reduction is what justifies a massive price tag. Okay, now let's talk competitive advantage. If they're moving into this broader market, does the old DocuSign still have a defensible economic moat?
They absolutely do, and it's what we'd classify as a wide moat. It's built on 3 pillars, and IAM only makes them stronger.
What's the first one? First is network effects. DocuSign has become a verb, like Google. That ubiquity creates trust, which is non-negotiable in legal transactions. A lawyer isn't going to risk a merger contract on a no-name service to save $5. Trust is everything.
Okay, what's the second pillar, and how does IAM strengthen it?
High switching costs. For those big enterprise customers, DocuSign isn't just an app, it's middleware. It's deeply integrated into their core tech stack Salesforce, SAP, Workday.
Untangling all that is already a huge project.
A massive project. Now add 10 years of mission-critical AI-enhanced legal data into that repository. Migrating becomes a logistical and legal impossibility. It's like digital cement.
But hold on, high switching costs are great, but if a company is frustrated with the product, doesn't that just turn into resentment?
That's a critical point.
It seems like that would encourage them to start looking for alternatives the second their contract is up.
You're right, and it's why the product experience for IMM has to be stellar. If the value isn't there, those switching costs become a temporary barrier, not a permanent moat. That said, even motivated customers struggle to move. Which brings us to the third pillar, the regulatory and compliance moat.
And that's especially relevant for big banks, government.
Exactly. DocuSign holds these non-negotiable global certifications. FedRAMP High for U.S. government, IDs for the EU. These are incredibly expensive and time-consuming to get. They basically lock smaller competitors out of highly regulated sectors. It's a huge buffer.
So we have a stable, cash-generating company, a strengthening moat, a compelling new product pivot. If all that is true, why is the stock priced where it is? Let's shift. What are the risks and headwinds holding this thing back?
Right. There are short-term operational hurdles and then some very serious long-term existential threats. In the short term, they're going through a major sales restructuring.
Under the new CRO?
Yes. They're splitting the sales force into hunters for new customers and farmers for renewals. Strategically, it's necessary for the IAM pivot, but these things always cause short-term chaos. Confusion, productivity dips. It usually lasts 3 to 6 quarters.
And you mentioned a drag on their gross margin, which is already an impressive 81.8%.
That's the second short-term pain point. They're migrating their data infrastructure from their own data centers to the public cloud Azure and AWS. So they have these temporary dual running costs.
Paying for both the old and the new at the same time.
Exactly. They're paying for the old depreciated centers and the expensive new cloud capacity. That's knocking about 100 basis points off their gross margin, and that pressure is expected to last through FY26.
Okay, those seem fixable over time. What about the structural, the existential risks, the ones that really challenge the whole long-term thesis?
The biggest one is the commoditization threat. The basic e-signature is already dirt cheap or free. Giants like Microsoft and Adobe can just bundle that feature into their existing software suites.
So if IAM fails,
If IAM fails to deliver real value, DocuSign risks becoming a dumb pipe, and their pricing power on the core product just evaporates.
And speaking of Adobe, they own the PDF standard. That feels like a huge native advantage.
It is. Adobe can offer Adobe Sign as a zero-friction checkbox add-on to Acrobat Pro. They have a massive installed base, especially in the mid-market. That creates a natural ceiling on DocuSign's expansion there.
But the risk that really ties into the future of IAM, and the one we wanted to end on, is the AI regulatory landscape, especially in Europe. This one seems existential.
It runs straight into the path of global scalability. The EU AI Act is designed to protect citizens, and it classifies any AI systems used in legal interpretation or employment decisions as high risk.
And since IAM uses AI to summarize contracts and score risk,
It walks right into those high-risk crosshairs.
and what does being classified as high risk actually mean in the real world?
It means huge compliance obligations, mandatory human oversight of AI decisions, exhaustive third-party audits, and massive fines for non-compliance. We're talking up to 7% of global turnover.
Wow.
And if US and EU regulations diverge, they might have to maintain two different product stacks. Two R&D teams building two different versions of IAM. That would just kill efficiency and scalability.
That is the ultimate test. Okay, let's pivot to the final verdict, the valuation. When we run DocuSign through a Buffett-style quality checklist, what's the conclusion? Is this a deep value cigar butt, or is it something else?
The conclusion is that it's a high-quality compounder. And to clarify that for the listener, a cigar butt is cheap because it's a struggling company. A compounder is rarely cheap, but it's a great company that just keeps growing in value.
So it fails the old-school PE tests.
It fails the strict 1950s PE and price-to-book tests of value investing, yes, but it passes the modern tests of quality with flying colors.
Which tests are those?
The gross margin is elite, nearly 79%. The free cash flow yield is attractive at around 7.7%. And the balance sheet is a fortress, almost no net debt, a debt-to-equity ratio of just 0.08.
We've also seen a rotation in who owns the stock, which suggests the market's perception is starting to shift.
Yes, exactly. The pure growth investors are gone. They left when the pandemic growth slowed down. Now you're seeing value or growth at a reasonable price, investors come in.
Like Value Act Capital.
Right, a constructive activist firm. That signals belief in the IAM thesis. And crucially, a macro investor like Stanley Druckenmiller's family office just initiated a position. That's a powerful signal that the risk-reward is looking favorable to some very smart people.
Let's put some numbers on that risk-reward with a discounted cash flow analysis. We're using the trailing FCF of about $988 million. What does the current stock price of roughly $70 imply about the market's expectation for future growth?
If we run a conservative case, let's assume the IAM pivot completely fails. The business stagnates, zero growth for 5 years. The intrinsic value comes out to $64.90 per share.
So the market is pricing in near zero real growth. It's treating DocuSign like a utility that just pays out cash.
That is the consensus expectation right now. And by the way, if you want a tool to track that kind of broader market sentiment and historical context, you might want to check out the iOS app Buffett Indicator. It can help put these big picture valuations into perspective.
So if that's the stagnation baseline, what's the prize if the IAM pivot actually succeeds?
Our nominal case assumes a realistic 8% growth for 5 years, tapering down to a 4% terminal growth rate.
Wow.
In that scenario, the intrinsic value leaps to $119.65 per share.
Wow. Okay, so that suggests a significant asymmetric opportunity.
It does. At the current price, the market is giving them almost no credit for the IAM upside. If the pivot works, the upside is about 70%. If it fails and stagnates, the downside is relatively capped near $55 to $60, and it's supported by that massive free cash flow and the buyback program. That's a very strong setup.
So that brings us to our final takeaway. What does this all mean for you listening right now?
The key takeaway is this. DocuSign's financial story is one of painful but necessary maturation. The future shareholder value rests entirely on one question. Can they successfully transition the unit of value from the commoditized signature to the high-value agreement record with this IAM platform?
And here's a final provocative thought for you to think about. DocuSign must pivot to AI with IAM to secure its future. But that very move runs it straight into the path of complex regulations like the EU AI Act. Will the steep compliance costs and development restrictions in Europe undermine the scalability of the very product that's designed to save the company? That cost of AI compliance is the hidden variable in the whole equation.
A profound tension between innovation and regulation.
Thank you for joining us for this deep dive into DocuSign. We really hope this analysis helps you understand the nuance between a company's past and its potential future.
And if you found this useful and want access to more advanced content, welcome to join our Deep Value Club membership or subscribe to us on Apple and Spotify podcasts channel. deep value investing.
And as always, a reminder, all of this analysis is based on publicly available sources and is for educational purposes only. It does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.